Today, we will be discussing inventory management, mainly the different types, calculating the cost of holding inventory, and the pros and cons of engaging in inventory management. How is it that an entrepreneur decides how much inventory to keep? Is it smart to have inventory ready in case of a large order, or is it better to keep only what you need in order to free up cash? That's what we'll be taking a look at in this presentation. In a case study of the Coca-Cola bottling plant in Ilora, Nigeria, S.L. Adeyemi and A.O. Salami look at how inventory decisions are made. Investopedia describes inventory management as the practice of overseeing and controlling the ordering, storage, and use of components that a company uses in the production of the items it sells. They continue to say that inventory management is also the practice of overseeing and controlling the quantities of finished products for sale. However, Adeyemi and Salami write that, quote, "The principal goal of inventory management involves having to balance the conflicting economics of not wanting to hold too much stock, thereby having to tie up capital so as to guide against the incurring costs such as storage, spoilage, pilferage, and obsolescence, and the desire to make items or goods available when and where required, quality and quantity-wise, so as to avert the cost of not meeting such requirement," end quote. In layman's terms, it means figuring out how much stock you should carry, more than you need, or just enough. Now we'll take a look at the different types of inventory management. First, we'll take a look at different inventory methodologies, which include the manual accounts method, the perpetual method, the periodic method, and the LIFO and FIFO methods. Then we'll take a look at different inventory management systems, which include manual, barcode, and RFID management systems. The manual accounts method is where a business owner with a smaller inventory will count the inventory by hand. This method doesn't cost the business any money except labor, since there's no expensive equipment to buy. The downside to the manual accounts method, however, is that human error exists and it can be very time-consuming. The perpetual method uses technology like barcodes or radio frequency identification, also known as RFID, to keep track of inventory daily. This method is very efficient and it doesn't take very long to complete, at least compared to manual accounts. The downside to the perpetual method is that it costs a lot of money to purchase, maintain, and update. You can check out that clip at the bottom too if you want to learn more about RFID systems. The periodic method is used when inventory is not calculated on a daily basis. This inventory calculation may be done quarterly, twice a year, or even once a year. The business will determine how much inventory there is based on how much inventory was used throughout the specified time frame, less the amount of inventory at the time of the count. Last in, first out, or LIFO, is used when people sell products on demand. This methodology is ideal when a business needs to sell the newest and best items first. First in, first out, or FIFO, is used when a business is selling a product with an expiration date. It's best to sell the oldest product first as long as it's still within the expiration date time frame, so that you don't have to waste any product. Now let's take a look at how to calculate costs of, specifically, holding inventory. It's really a simple equation. Just take the sum of all costs associated with inventory, such as the actual cost of the inventory itself, the physical space used in the storage and production of the inventory, the cost of handling the items, or how much a business pays someone to package and pallet the products, and the cost of deterioration and obsolescence. On this slide here, I have come up with a fake donut store and a fake inventory holding cost system. These items include the material to make the donuts, the opportunity cost of not selling cupcakes. I came to this number just arbitrarily by saying we could make an extra penny if we were selling cupcakes instead of donuts, but we like selling donuts and we don't like selling cupcakes. So we could be making $304 extra per month if we were selling cupcakes. Rent, depreciation, utility costs, insurance, taxes, labor, packaging, deterioration, and both forms of obsolescence, functional and economic. That grand total of holding costs per month comes to $39,147. Sometimes a business will do this on a percentage basis. I came up with a random number here. If I were to express it as a 25% holding costs, my holding costs would be $9,787 at 25% holding costs. So now we're going to take a look at the pros and cons of inventory management. When reviewing an article published in EMS World magazine, author Mike Rubin touched on two important topics related to managing inventory: push systems and pull systems. He goes on to write, quote, "There are two fundamental approaches to managing materials: push systems, most of which are derivatives of something called Material Requirements Planning, or MRP, and pull systems, which are also known as Just-in-Time, or JIT. MRP considers three things: how much of each item you have, how many more finished goods you will need to meet demand, and what components you'll need to achieve said requirements. MRPs depend a lot on sales forecasts. JIT doesn't focus so much on sales forecasting because the goal is to minimize, or in some cases even eliminate, inventory. If you want to learn more about the difference between push and pull systems, there is a link to a YouTube video that is very helpful. So, the pros and cons of a push system are as follows. The pros: business owners develop critical forecasting skills. This is important because a business owner will learn how to predict how much stock is needed during the different times of the year to make sure inventory is ready to ship when purchased. When a business owner uses a push system, it is necessary to keep track of inventory as it is ordered, used, and sold. This will help to establish a more efficient inventory management approach. A business owner will understand how much time is needed before the materials to make the product will arrive, and how much time is needed to manufacture the product being sold. When you keep materials and product on hand, it is easier to keep track of where your finished goods are, as well as the materials required to make the good being sold. Now the cons. Sales forecasts are not always accurate. There are so many elements that determine how well a product will sell, it is very hard to forecast sales. If a business does not sell the amount predicted in the forecast, then it may be overwhelmed with unsellable inventory. If the product that a company is selling all of a sudden becomes obsolete, then holding inventory means that business will, again, be sitting on unsellable inventory. With price fluctuations, the materials purchased to make the good a business sells may become less expensive later on. If a business makes inventory to sit on for a while, the price of materials may go down, making the profit margins smaller. So the pros and cons of a pull system are as follows. The pros: a business owner will never have more than needed. When this is the case, the inventory will only consist of what is needed, reducing the risk of wasting inventory or sitting on unsellable inventory. When a business orders products and materials regularly from its suppliers, it is much easier to establish a relationship with them, thus helping the business to get what it needs when it needs it, if available. It is also easy for the business owner to communicate shortages. When a business constantly monitors its inventory due to limited availability, it is easier to see what materials are needed to manufacture the product and get that material in quickly. The cons: a business owner who uses a pull system may not have all the materials needed when the business needs it. It may be much easier to get the information of the inventory shortage through the appropriate channels and quickly, but if the materials or products are needed at that moment, there is an unavoidable wait time which can cost sales or business relationships if it's a frequent issue. The opportunity cost of not having what is needed when it's needed is that people will not purchase the product sold by that business. This could lead to brand deterioration, lost partnerships or relationships, and lost sales due to competitors having the product available when it's needed. It may also hinder growth due to the market opportunity that was not seized. A perfect example of this was listed in an interview done by Guy Raz of Rod Canyon on the podcast How I Built This. Rod Canyon, founder of Compaq Computers, created a portable computer that one could travel with. IBM was Compaq's main competitor and came out with a product of their own, similar to that of Compaq's. Compaq sales dropped because IBM was the major player at the time. And Rod Canyon said, quote, "Let's assume that IBM's product is not better than ours, and that it's in limited supply," end quote. He goes on to say, quote, "We're going to build these things," meaning Compaq Computers, "store them, and wait for the orders to come," end quote. He then said, quote, "If the orders never come, yeah, we're in deep trouble, but we're in deep trouble anyways if the orders don't come," end quote. He ended up storing big tractor trailers, nearly 20 of them, around Houston at the time, waiting for orders to come. IBM announced that their computers were in limited supply, and Compaq almost immediately got a huge wave of orders. And since Rod decided to build the computers and wait for the orders to come in, they had the computers to fill the orders. If you want to listen to that podcast, I've left a link to the How I Built This podcast at the bottom, and then you'll just want to search for Compaq Computers, Rod Canyon to hear the reference story. Here is the bibliography, and thank you so much for listening.